Hello everyone, today in this video, we will talk about the topic, which is one of the oldest forms of investing in the world. Today we will talk about dividend investing. In this video, we are going to discuss what a dividend is and what dividend investing is. Is dividend investing a good strategy? And the risk of investing in dividends. Let us first understand. What is the dividend? Many beginning investors do not understand what a dividend is as it relates to an investment, particularly for an individual stock or mutual fund. A dividend is a payout of a portion of a company's profit to eligible stockholders, typically issued by a publicly traded company. Let us understand the basics of dividends. Shareholders of any given stock must meet certain requirements before receiving a dividend payout or distribution. You must be a shareholder of record on or subsequent to a particular date designated by the company's board of directors in order to qualify for the dividend payout. Stocks are sometimes referred to as trading ex-dividend, which simply means that they are trading on that particular day without dividend eligibility. If you buy and sell stock on its ex-dividend date, you will not receive the most current dividend payout. Now that you have a basic definition of what a dividend is and how it is distributed, let's focus in more detail on what more you need to understand before making an investment decision. Now let us understand, what is the dividend yield? It may be counterintuitive, but as a stock's price increases, its dividend yield actually decreases. Dividend yield is a ratio of how much cash flow you are getting for each dollar invested in a stock. Many novice investors may incorrectly assume that a higher stock price correlates to a higher dividend yield. Let's delve into how dividend yield is calculated so we can grasp this inverse relationship. Dividends are normally paid on a per-share basis. If you own 100 shares of ABC Corporation, the 100 shares is your basis for dividend distribution. Assume for the moment that ABC Corporation was purchased at 100 rupees per share, which implies a total investment of 10,000 rupees. Profits at the ABC Corporation were unusually high, so the board of directors agrees to pay its shareholders 10 per share annually in the form of a cash dividend. So, as an owner of ABC Corporation for a year, your continued investment in ABC Corporation result in 1,000 rupees of dividends. The annual yield is the total dividend amount, 1,000 rupees, divided by the cost of the stock, 10,000 rupees, which equals 10%. If ABC Corporation was purchased at 200 rupees per share instead, the yield would drop to 5%, since 100 shares now costs 20,000 rupees, or your original 10,000 rupees only gets you 50 shares, instead of 100. Assessing dividend-paying stocks. The real question one has to ask is whether dividend-paying stocks make a good overall investment. Dividends are derived from a company's profits, so it is fair to assume that, in most cases, dividends are generally a sign of financial health. From an investment strategy perspective, buying established companies with a history of good dividends adds stability to a portfolio. Your 10,000 rupee investment in ABC Corporation, if held for 1 year, will be worth 11,000 rupees. Assuming the stock price after 1 year is unchanged. Moreover, if ABC Corporation is trading at 90 rupees a share a year after you purchased it for 100 rupees a share, your total investment after receiving dividends is still break-even, 9,000 rupees stock value plus 1,000 rupees in dividends. This is the appeal of buying stocks with dividends. Let us see the risks of investing in dividends. During the financial meltdown in 2008 to 2009, almost all of the major banks either slashed or eliminated their dividend payouts. These companies were known for consistent, stable dividend payouts each quarter for literally hundreds of years. Despite their storied histories, many dividends were cut. In other words, dividends are not guaranteed and are subject to macroeconomic as well as company-specific risks. Another potential downside to investing in dividend-paying stocks is that companies that pay dividends are not usually high-growth leaders. There are some exceptions, but high-growth companies usually do not pay sizable amounts of dividends to their shareholders, even if they have significantly outperformed the vast majority of stocks over time. Growth companies tend to spend more dollars on research and development, capital expansion, retaining talented employees, and mergers and acquisitions. For these companies, All earnings are considered retained earnings and are reinvested back into the company instead of issuing a dividend to shareholders. I hope you find this video helpful. If yes, please don't forget to like and subscribe. Thank you.